Hi, and welcome back to the channel. Learn Real Estate 123. Today, in this video, we're going to delve into the fascinating world of the 30-year mortgage rate and why they seem to fluctuate on a daily basis. Understanding these factors that make rates go up and down can have a major impact on your financial decisions and the right time to buy a home. So join me today as I delve into this complex issue and break it down in simpler terms so you can stay ahead of the curve. Okay, let's get started. Why do mortgage rates go up and down every day? And how does it affect your financial decisions? Have you ever wondered, how does it actually work? Well, today we'll break down this complex topic into simpler terms so you'll have a better understanding of how it really works and be ahead of the curve. So what factors actually control the rate on the 30-year mortgage? Well, the first thing is that the Federal Reserve does not. When the Federal Reserve announces what its policy is going to be for the month or the quarter, meaning they're going to raise rates, keep rates the same, or lower rates, that's called the discount rate. And the discount rate is the rate that the Federal Reserve charges other banks to borrow money from them literally overnight. So it controls short-term vehicles like credit cards and car loans. But the 30-year mortgage rate, that's not controlled by the Fed. So most people will use that to see whether it's the right time to refinance or to buy a home or kind of take a gauge of the market. But that's a huge mistake because rates go up and down every day. So what factors actually control the 30-year mortgage rate? The economy. So the stock market, the gross domestic product report, the unemployment report, the inflation report. In fact, inflation is huge because higher inflationary environments equal higher interest rates. So the most important thing is the bond market. The most important thing to understand is the bond market. The bond market really is directly tied to the rate being charged for the 30-year mortgage, and specifically the 10-year Treasury note. What is that? Well, it's a debt instrument. The federal government will pay you an interest rate called a yield for buying a bond and holding it for 10 years. And the yield on that 10-year Treasury plus what's called a spread is your 30-year mortgage rate. What's the spread? The spread is nothing more than the amount of money that the investors want to make on top of the yield for investing in the mortgage. Most investors who are going to fund 30-year mortgages use the bond market to do so, and therefore that yield plus the spread, that will give you your 30-year interest rate. But there is one more key element, which is natural disasters or world geopolitical issues or things that cause volatility in any market, and that could make rates snap up. So understanding how rates move is extraordinarily important because it could save you hundreds of dollars a month. So in conclusion, it's really important that you understand the nature of mortgage rates and the factor that controls these rates, because that can empower you to make much better decisions when it comes to home ownership. Okay, well that's the video. Before we go, subscribe to the channel for more videos on real estate. Share your experience with mortgage rates in the comments below. Your feedback is extremely important. Thanks for watching, and we'll see you next time.